Hey everyone, Emily Carter here. Oil prices are cooling down, energy stocks are under pressure. But one giant keeps paying investors, and paying big. Today we're breaking down Chevron, ticker CVX, one of the world's most powerful energy companies. Is it still a solid buy for dividend investors, or has the oil boom already peaked? Let's find out. Chevron is an American multinational energy giant. Founded in 1879 and now operating in over 180 countries. It explores, produces, refines, and sells oil and gas. But here's the key. It's also investing billions in low-carbon projects like hydrogen and renewable fuels. So while most people think Chevron equals oil, it's quietly becoming an energy transition player too. Let's talk numbers. Chevron stock trades around $154, giving it a market cap of roughly $285 billion. In 2024, it generated $196 billion in revenue and nearly $21 billion in profit. And this company prints cash, returning over $15 billion to shareholders last year. Chevron pays $6.52 per share annually. That's about a 4.2% yield. And it has raised its dividend for 37 straight years. That's why many investors call Chevron a dividend king of the energy world. Chevron's growth comes from two engines. Upstream, exploration and production, mainly in the Permian Basin and the Gulf of Mexico. And downstream, refining and chemicals, turning crude oil into gasoline, jet fuel, and petrochemicals. Recently, the company reorganized its business structure to simplify operations and cut costs, a move Wall Street absolutely loved. At the same time, it's ramping up its exposure to liquefied natural gas, LNG, and hydrogen, giving investors exposure to the clean energy transition while still cashing in from oil. To understand where Chevron's next decade of growth comes from, we've got to look at its three biggest ongoing projects, each representing a different part of the company's strategy. First, the Ballymore project in the U.S. Gulf of Mexico. Chevron just announced first oil from this deepwater field in 2025. It's expected to produce around 75,000 barrels of oil per day at peak. That's massive. What makes Ballymore unique is its location in the Norphlet Formation, one of the newest deepwater discoveries in the region. For investors, this means long-life production and high margins, as Chevron leverages existing infrastructure to lower costs. Think of Ballymore as Chevron's next-generation deep-sea cash machine. Second, the Future Growth Project in Tengiz, Kazakhstan. This is one of the largest oil field expansions on Earth. Operated through the Tengiz Chevron partnership, the project aims to boost output by 260,000 barrels per day, increasing total capacity to nearly 1 million barrels daily. The focus is on next-gen gas injection and processing facilities, which enhance recovery rates and reduce flaring. This isn't just an expansion. It's a multi-billion-dollar modernization effort that locks in production for the next 20 years. And finally, Chevron's step into the future of clean energy. The ACES Delta Hydrogen Project in Utah. Here, Chevron is building one of the largest hydrogen storage systems in the world, using underground salt caverns to hold renewable hydrogen produced via electrolysis. This project shows Chevron isn't ignoring the transition, it's investing in it. The goal is to store enough hydrogen to power entire cities during peak demand, bridging the gap between renewable generation and reliability. So while most investors see Chevron as an oil company, its future may also run on H2 molecules, not just hydrocarbons. Let's take a quick look at Chevron's position. The company's strengths lie in its enormous scale, diversified portfolio, powerful cash flow, and that rock-solid dividend investors love. On the flip side, it's still heavily exposed to oil price swings, faces regulatory pressure, and has been slower than ideal in shifting toward renewables. In short, Chevron's biggest challenge is finding the right balance between today's profitability and tomorrow's sustainability. The biggest risks? Oil price volatility, political tensions in production regions, and the global energy transition itself. If crude drops below $70, profits can thin quickly. But strong cash reserves and low debt give Chevron resilience. Investors should watch how fast the company scales its new energy projects. because that's what will define its valuation in the next decade. So what could 2026 look like for Chevron? Let's imagine three possible paths. In the bullish scenario, if oil stays strong around $90 a barrel and global demand keeps rising, new projects like Ballymore and Tengiz could lift production by nearly 10%. That would push earnings to about $9.50 per share and free cash flow above $30 billion. A setup that could send the stock toward the 185 to 195 range. In the base case, if oil trades somewhere between $75 and $80, growth in hydrogen and LNG would likely balance out weaker refining margins. Earnings would hover around $8 per share, dividends could rise another 5%. Steady, predictable, the classic Chevron story. And in the bearish case, if crude slips to around $65 and demand cools, earnings might fall below $7 and buybacks could slow down. But even then, that 4+% dividend acts like a cushion, keeping income investors anchored through the turbulence. So whatever the oil cycle brings, Chevron's strong balance sheet and consistent payout record make it one of the safest seats in a very volatile sector. So, is Chevron a buy? For dividend investors, yes, it's a fortress. For growth chasers, it's steady but not explosive. If oil stays in that sweet spot near $80, expect solid income and moderate appreciation. And if the hydrogen and deepwater bets succeed, we could be talking about Chevron 2.0. If you found this breakdown useful, hit like, subscribe, and tell me in the comments. Which scenario do you believe in? Bullish, base, or bearish? Follow for more no-hype market breakdowns, and I'll see you in the next video.